Hello. Any sound? Hello. No sound.
Testing, testing. All right.
Okay. Good morning, clients, remisiers, and dealers. Thank you for logging into our usual Monday webinar. I'm Joshua, the head of research, and today we'll be talking about mainly U.S. stocks, but I will give a update on Pan United, and my colleagues will give updates on Intercontinental Hotels, Inconix brands, Genworth, and we initiated on SodaStream last week Friday. Disclaimer. Okay, Pan United Corp has made a move into expanding its port in China. And this slide is to update on that. Just to give a quick recap on Pan United, it's got a market cap of $500 million, earnings of about $51 million. It has 3 free cash generative businesses. Basic Building Resources forms the largest earnings contributor at about 78%. It has a 30% market share in Singapore for ready-mix concrete and cement, which means it's a perfect proxy for Singapore's infrastructure boom. And BCA estimates construction output to 36 billion this year and 34 billion the next 2 years. So we expect earnings there to increase this year and hold steady. Being a 30% market shareholder, it is a better proxy to this infrastructure boom than construction companies. Shipping is is a small part of the business, 3% of earnings, but it is there to basically vertically integrate with the basic building materials to ship materials into Singapore. The major thing that we want to focus on today is ports and logistics, which is about 20% of earnings. Now, this is the earnings driver that will likely become 29% of earnings and will lead the earnings growth over the next 2 years and beyond. Now, it owns Pan United owns 85.5% of a top 10 multi-cargo river port called Changshu Xinhua Port, which is running at almost close to 90% capacity at the moment. Is extremely profitable at 30% operating margins and 40% EBITDA margins. Now, this port bought its neighbor, which is adjacent east to it, in the first quarter of this year, called Changjiang International Port at 1.3 times NTA. Now, this little port, we decided, is running below break-even, is a new port, and that's part of the reason why. But by adding this port to CXP, basically capacity is going to go up by 60%. Now, PUC is pretty confident that CCIP can be brought to profitability by the mid-2015s because CXP is running at capacity limit already, and all they have to do is take down the fence and realize some economies of scale. The full benefits of this acquisition will come about in 2016. Now, because CCIP is running at a slight loss at the moment, we actually brought down our earnings this year and next year due to carrying these losses from CCIP and also due to the debt that needed to be taken on by PUC to buy this port. The increased gearing means more interest payments. So we took down our earnings estimates this year and next year from 9.7 to 9.1 cents this year, and next year 11.1 to 10.3 cents respectively, which still nonetheless means there is earnings growth, as last year's earnings was about 8 cents. Okay, so 8 cents to 9.1, 9.1 to 10.3, and by 2016 we think that earnings will be about 12 cents, which implies that the stock is now trading at less than 8 times PE, which we think is a steal for what are two very resilient businesses. The BBR is basically 30 market leader in Singapore, 30% market share. And CXP, by acquiring CCIP, actually takes out a competitor. And in the region now, there are only two ports, Taichung Port and CXP, right? And this means it's a duopoly. So there are many OEMs running in that area which require the services of these two ports, and being a duopoly, it's likely that they will not compete irrationally, but rather have come to a market consensus on their rates. Thanks.
Hi, this is Yongkai here. I'm the US analyst, and today I'll just be giving a very quick brief overview about the earnings of 3 US companies. So first is Intercontinental Hotels. If you remember, I did a non-weighted presentation last year. So what about Intercontinental Hotels? Just a brief recap. It's the largest hotel group with 687,000 rooms. So share price is more or less trended since December. 52-week range of $26 to $34 and market cap of $8.5 billion. It's paying a dividend yield of 2.2%, which has increased every year since its IPO about 10 years ago. So because I need to present it once, so I'll just give a one-page refresher. If franchises manages these or owns 4,700 hotels and 687,000 guest rooms in nearly 100 countries. So Intercontinental Hotels Group, IHG, is the biggest hotel group, and its subsidiary brand, Holiday Inn, is also the largest hotel chain in the world. It's 38% bigger than number 2 player Best Western. Almost all its hotels are franchise, so you don't need any capex, you don't need any debts or asset ownership, whereas you still generate strong cash flows, high margins, and require low capital requirements. Royalty fees is around 5% of room revenues, and on top of which, last year, the franchisees contributed $1.1 billion to support marketing. So financials, you have 22% margins, 76% ROE, and you have returned $1.2 billion in dividends and buybacks in the last 2 years, which is equivalent to 15% market cap. So what about the 2013 results? Overall, the RevPAR recognized healthy growth of nearly 4%. Okay, so this is led by Americas. So you have the US and South America, you have the Middle East, Indonesia, Thailand, Japan outperforming, whereas Greater China declines because of you have too much room supplies. Operating income increased by 10% on the strength of Americas. They also divested 2 Intercontinental hotels at 19 to 20 times EBIT for 360 million cash. So, since this is a non-retail presentation, our point is really want to highlight about this company. We did a standalone basis. We calculated what's the managed and franchise operating income, and then we regarded it as a 4% fixed income stream with distribution growth. So this alone could be worth $9.5 billion, and you add in the ongoing return of capital from divestments. So we could be looking at a 20% upside for IHG. Next, Inconix brand group. If you recall, we actually totaled this idea for the consumer discretionary play. So this is the number 2 global licensor after Disney. Share price $41, so it's almost at a 52-week high, $2.7 billion, and about 12.6 times price over free cash flow. So this company, what it does again, it does brand licensing. So it doesn't own any inventory, doesn't lease any stores. All it does is receive royalty fees in return for licensing its brands. So free cash flow is up 66% quarter over quarter and 27% year over year to $230 million, which is 10% higher than its full year guidance in the quarter. So this is due to one-off $10 million payment received. 2014 guidance is in line with our expectations. 3 new JVs were set up in second half of 2013. So international expected to contribute more than 40% revenue, and they also repurchased 24% of outstanding shares in last year alone. So the average cost is $27.60 per share compared to today's share price of $41. So they really bought back at a bargain. They also authorized a new $500 million repurchase. So in all, Inconix has returned 20% since our initial reports, but we continue to reiterate a trading buy with a 12-month target price of $47. So we actually did these calculations based on our WACC, which we have detailed in the report that we issued about 1 to 2 weeks ago. So this is about 15% potential upsides. Lastly, Genworth. So this combination of few mortgage operations, insurance operations. So you have a tailwinds from life and mortgage insurance. Share price has almost doubled from the 52-week low, 8.5B market cap and a 0.71 times price over book. So, long-term care, they actually received regulatory approval to implement nearly $200 million of premium rate increase to date. So this increase alone is going to increase the overall group EPS by 25% year over year. Okay. One thing I want to highlight is that majority of the shareholders, 84% of them, actually accepted this rate increase despite it being 10 to 50%. Okay, so this how valuable this long-term care is. For mortgage insurance, this used to be a dirty words because of the property crash, the bubble. But for the first time since 2007, they achieved full year profitability. They also saved $560 million from mitigating losses, working out those foreclosures, which exceeded their full year targets by double. No further capital support is expected at this moment, so this is good on a standalone basis. This Canada MI is 57.4% owned and is floated on the Toronto Stock Exchange. It now trades at 1.1 times PB and continues to generate excess capital. Whereas Australia MI, all this while we are talking about the IPO and they are still in the pipeline. There's only 2 windows for IPO, so it's pending the interim results. So you just have to keep a lookout. The loss ratios also improved year over year and sequentially to all-time low of 21%, which means that for every $1 premium they collect, they only paid out 21 cents of losses. Okay, so lastly, high interest rate environment is actually very positive for insurance companies. Just for perspective, if you increase 1% investment yield, you double the operating profits at Genworth. Okay, so you are going to double the EPS to roughly around $2.80 just on 1% investment yield higher. So in all, Genworth has returned 60% since our initial report in June 2013, but we continue to reiterate trading buy as explained in the next slide. So you can tell this is some of the parts. We actually apply a very generous 20% conglomerate discounts, and we still get a potential 10% upside. And this doesn't factor in any higher investment yields, which will double the operating income. Next, I'll hand over to my colleague Kenneth.
Morning, everyone. I'm Kenneth, and I'm going to talk to you in detail about we initiate SodaStream. Okay, this is definitely a stock that'd be interesting for you to just put on your radar. Okay, and we'll go into the details why. Okay, SodaStream. Okay, I'm going to show an ad onto a video ad, but due to the nature of the webinar, you won't be able to hear any volume. But I think the images probably paint a picture itself. So let's go. Okay, it's not working. Never mind. Okay, oops. Okay, let's do a snapshot. Okay, so here's SodaStream. It's going at $40 right now on the Nasdaq stock market. It's going at a PE of 20, but for a big growth stock like this, we think that it is cheap for now. Okay, here's the price chart of SodaStream. As you can see, it actually fell from its 52-week high of $75 around there, all the way down to 35. Okay, so and you can see as well as for a higher historic growth stock, as this is the market used to rate SodaStream at about $75, which corresponds to a roughly 37 times PE. That was how strong the growth story was. Now, because of a weak fourth quarter and guidance for the year of this year, I think the market is afraid that the growth story has been impaired, and that's why the price has dropped so low. So we shall see what is the story around SodaStream right now. Just want to highlight to you that this is the price chart on top, but here's the PE chart below, so you can see historically what are the ranges of PE that SodaStream is trading on. And as you can see right now, we are actually at a historical low again for PE, which is why now I think it's a good time to discuss SodaStream. Okay, so when SodaStream is firing on its growth cylinders, right, the market tends to price it at 28 times PE, which is the average here. When there's speculation on buying out SodaStream by any of the major drink brands companies, right, the market tends to price SodaStream at 37 times. Okay, so here's where we are today. Okay, this is a snapshot. Okay, so what is SodaStream? So SodaStream basically is a world leader in home carbonation or do-it-yourself sodas, and it has very little global competition. It already operates in 45 countries in 60,000 stores. It has an installed base of 6.5 million households. So 6.5 million households actually own a SodaStream machine. Okay, there are 6 major partnerships and growing: Ocean Spraycraft, Samsung, eBoost, Campbell, and Breville. Um, Last year's revenues were 560 million with net profits of 46 million. Okay, with a target to hit 1 billion by FY16. It sold an equivalent of 4.6 billion cans over the year. And here's your geographical distribution. You can see also here that the 3-year revenue CAGR was close to 40%, and the 3-year net income CAGR was close to 50%, and that explains why at one time SodaStream used to trade at 37 times PE. Okay, so Americas account for 40% of total revenue. Western Europe is 45% of total revenue. Central Europe, Middle East and Africa is 16%, and Asia is 9%. And I believe Asia is actually a very big growth center. In fact, they're growing in all countries, but Asia is not one to ignore. Okay, here's a quick brief history of SodaStream. SodaStream actually started in 1903, 100 years ago, and SodaStream actually built the very first home carbonating soda. So they've been in this industry for some time, but only 2007, after a buyout from Fortissimo Capital, and they listed SodaStream on the Nasdaq in just 2010. Okay, only here is when there was a big push globally to for SodaStream to basically ride on the mega trends of health customization and cheaper pricing. Okay, for this sort of growth that we're seeing now. 2011, worldwide retail locations surpassed 45,000 stores, including 7,000 in the US. And 2012, they launches Sauce and Revolution soda makers and first co-branded flavors. Okay, annual sales reached 436 million. Okay, what's the business overview? Basically, SodaStream manufactures home beverage carbonation systems, which enables customers to easily transform ordinary tap water instantly to carbonated soft drinks and sparkling water. Okay, it develops, manufactures, and sells basically soda makers, the exchangeable carbon dioxide cylinders, okay, and the consumables, which basically consist of the CO2 refills, reusable carbonation bottles, and flavors. This follows a razor and razor blade model, or a printer and cartridge model, depending on what you're familiar with. So basically, the soda makers themselves are sold at low volume to encourage and install the base for higher margin, incurring income from refills and consumables. So this is their basic business model. So here's the investment thesis, okay, in a nutshell. So SodaStream is the market leader in a high growth market, okay, of customizable soft drinks. And we've seen the historical CAGR of 3-year CAGR of 40% and 50% for earnings and revenue. Now, price has been punished because of earnings miss in fourth quarter due to weak retail sales, combined with management decision to favor sales growth over margins. Hence, they had initiatives to repackage their soda makers over the Christmas season. Hence, it led to basically much cheaper prices and some logistical difficulty. So this led to net income growth for the year to be flat, but still hitting their revenue growth target of upside of 20%. In addition, Coke recently entered a partnership with Green Mountain Coffee Roasters to produce their version of a home soda maker. So the combination of these two things basically caused the market to be very pessimistic and drop the price down to less than $40. However, we feel that the growth story is still intact, and a larger installed base means higher future recurring revenue in consumables. So the company is embarking aggressive plans to return margin to historical levels, and for sales growth in 2014. So we believe that if the company can execute the fixable problems properly, margins are expected to improve. And since the growth story is still on, as the installed base grows, thus profitability should return. Now, at the current price, we believe that most of the downside is already priced in. So any sign of returning to profit growth or any M&A speculation will re-rate the stock. So on the short term, this is how we evaluate SodaStream. We think that SodaStream at the short term should be valued at 23 times PE of $46. And this could possibly be re-rated to 56 to 71 if the company shows a return to earnings growth or M&A speculation. So I just want to reiterate, if you buy SodaStream now, you probably have to be patient because it's in the midst of bottoming out. And the bottoming out process might take more than a quarter. Okay, so let's look at the products. All right, you can actually Google SodaStream on YouTube, and you can see all of their advertisements. And I would recommend that you do, because the advertisements are actually very good, and it gives you an idea of how it works. But anyway, SodaStream is revolutionizing the beverage industry by empowering people and enabling partners. Okay, for a simple, fun, better for you, environmentally friendly ways to make soda at home. So this is their SodaStream sauce, which is their most common model. Okay, and as you can see, you can basically turns water into carbonated water, and you can mix in flavors in to customize your taste and carbonation levels. Okay, we talked about this. Okay, here's the innovation pipeline. As you can see, this is their soda maker way back in 1903, and how it has evolved over time to something which is chic and modern, and now is leveraging on the mega trends now of consumer taste, of health and customization. Okay, here's the Source, which is the most common model, and these two, the Revolution and Aquabar, are their premium models. Okay. So when you buy SodaStream, here's what you're buying. You're basically buying better taste, health and wellness, variety, brand partnerships, and ease of use. SodaStream has over 100 flavors, 100 of their own flavors, as well in different delivery models like these. Okay, these are the innovative delivery models, different versions. Okay, here are the different bottles that they have. SodaStream is also branched into built-in systems like so. It's not just home carbonation anymore. Okay, here's SodaStream Professional, where now it's already running, or it's running in 350 active European test restaurants. So end of this year, actually 1.5 thousand units have been deployed, and these are in restaurants, not just in households. Strategic partnerships, here's where it gets interesting. SodaStream has already partnered with many beloved branded drink flavors like Ocean Spray, Campbell's, Kraft, eBoost, okay, Samsung, right? Here are some other flavors: Kool-Aid, Country Time, and Crystal Light. Okay, here's more. Here in terms of distribution, you can see the growth in terms of number of stores, how they've grown since May 2012 to 2013. It went from 11K stores to 14K stores, and here are the different stores that they've opened in. Okay, due to time, I'm going to have to skip through a lot of these and get to the valuation itself. Here's interesting to show that SodaStream is definitely getting traction. Even Samsung has partnered with them to produce their sparkling refrigerator over here, which is powered by SodaStream. Okay, in terms of marketing, this is important. So right now, the carbonated beverage is the carbonated beverages market is approximately 250 billion liters. This is based on 2012 statistics. SodaStream estimates they have 0.2% of the CSD market, carbonated soft drink, as well as sparkling water. 2% of sparkling water and 0.2% of the carbonated soft drinks. So as you can see, there's actually a whole lot more room for growth for SodaStream. The 5 megatrends that we believe is here to stay, corroborated by later on by industry analysis, is convenience, sustainability, health, wellness, value for money, and personalization. These are the things that SodaStream, their products, actually lends itself well to. Okay, skip this. Okay, so SodaStream is actually trying to reimagine and redefine the drink category, and that's the reason why the growth rates have been outstanding. Okay, they're not just trying to bring in another drink; they're bringing in a new drink delivery model, plus getting beloved brand flavors to basically sell their products through them to produce a new alternative flavor. Okay. These slides are therefore just for your reference, so you understand the differences between SodaStream and the comparisons with, let's say, Coke and the different products. Okay, SodaStream is marketing to a different type of market than Coke. Okay, and how the marketing themselves basically is a modern, chic way, and because you save bottles, you save the earth, and it's the evolution of soda drinking. That's how they're marketing themselves. Okay, here are essentially where they have physical facilities in the globe. As you can see, they already have facilities in basically the whole world, and the non-solid circles over here are essentially their expansion plans. So to improve margins, their gross margins, they are going to be having filling and distribution stations in the West Coast here, in Brazil, in Japan. So this will save costs on transportation. They're also going to be building, they have in the midst of building, a big manufacturing facility in Israel to accommodate their increasing sales. So as you can see, they actually are on an aggressive growth plan right now. Here are the retail partners. As you can see, they're really quite global. Okay, so here, historically, look at this CAGR. From 2009 to 2013, you can see the revenues have increased with a CAGR of 50+%, which is pretty ridiculous. Delving deeper, if you want to look at the quarterlies, so basically here the quarter-on-quarter comparisons, and you can see the same thing. The sales of SodaStream is quite seasonal. It's quite predictable as well, and you can see the same thing. The CAGR is about 50% plus as well. Now, going to the unit sales is very interesting itself. Okay, so if you look at the sales of soda makers itself, the actual machine, you can see the CAGR is about 40+%. So so how do we look at this? Every time a soda maker is sold, that is actually a source of future revenue because that is the installed base. So the more soda makers you buy, that actually bodes well for the future, for increased sales of refills, etc. Okay. Now, is this a fad? Well, if you look at the quarterly refill unit sales, you see that the CAGR of refill unit sales, right, is at a 26% clip. Okay, and this is good because essentially refills simply mean that these people are active users because you have to exchange your when you buy a SodaStream, you have to, and you use up all your CO2 in your canister, you have to bring your CO2 canister to the retail outlet or the distribution center to exchange it for a new one. And when every time you exchange it, the revenue goes into here. So as you can see, the increase of refill sales has also increased by 26%. So this shows that people are regularly using this and it's been increasing. Same for flavors, okay, 47%. And as they increase their number of branded juice partners or branded drink partners, right, you should see this increasing as well. And they have been doing so very rapidly. In fact, in the last 5 months alone, they have signed on 6 different drink partners, and I'll let you know what they are later on. Okay, but here are the highlights for last quarter. So last quarter, essentially, they hit all their targets for sales. As you can see, all of their unit sales are all been north of 20-30%. Okay, where they faltered basically is net income, where essentially the EPS was almost zero for the 4th quarter. Okay, for the reasons I mentioned before, they sacrificed their margins because of weak sales and logistic difficulties and the decision to discount their machine packages. Okay. Now, this is just for 4th quarter. How does that relate to the year? Well, year-on-year changes, we see that revenues have hit their targets of 20-30% for all of their segments. Okay, and because of the 4th quarter, which was almost zero net income, what we end up with is basically an net income which is minus 4% of last year. So note, this is not even a loss. Okay, they're not in the red. It's just that their earnings growth was slightly negative. Okay, almost it was flat basically. Okay, and what is the guidance going forward? So guidance going forward is like this: the approximate 15% revenue increase over last year. Okay, which is still respectable. This is due to a spillover from a weak 4th quarter to the first half. They think retail sales will be just a bit difficult. Okay, or only for the first 2 quarters. The company expects full year EBITDA to increase 11% over last year's one. But the thing is, right, if you exclude the changes in foreign currency exchange rates, it's because they forecast that a lot of their costs are in Israel, and because they forecast a stronger Israeli shekel, that's the reason why EBITDA is only 11%. If you ignore this currency exchange rate, if you use a constant currency assumption, right, actually the EBITDA is 25% actually. So the operational growth prospects is actually still there. Okay. So because of these issues here, Forex, etc., net income growth, they approximate only 3%. And the reason is because of two things. In addition to Forex weakness, right, you have a slight increase in tax rates from 10% to 12%, as well as higher depreciation costs because a big portion of their manufacturing facility in Israel comes online this year. So you are going to have high depreciation, okay, before profitability kicks in. So to give you an idea, here is the net profit chart for the last 4 years plus the forecasted FY15. So you see that from FY10 to FY13, there's actually a 40% CAGR for net income growth. If you just look at a 3-year, including the forecast, right, you still end up with a very respectable 16 times CAGR, which you think this is probably a very reasonable assumption going forward, seeing how there's such great growth prospects and how they have many plans in place to improve margins. Okay. Current situation, we talked about this, fourth quarter weakness, right? We talked about the guidance, but we believe that the growth story is not impaired. Okay. A closer look at the fourth quarter shows that the results were bad, but it wasn't horrible, and here's the reason why. First of all, SodaStream hit their revenue targets, which is 20% growth, despite slightly short on income target. Okay, this bodes well for the future. Assuming a current currency valuation, the actual adjusted net income would have actually been higher. Okay, if you adjust for this, right, net income is actually 45.9 million versus what we have now, 42.0 million. And then you would have seen a 4.5% growth quarter on quarter instead of a minus 4.2%. Okay, the business model has actually some resilience. I mean, the fact that they managed net income to stay black despite soft holiday sales, purposeful discounting of unit sales, and a reconfiguration of 60,000 units of finished goods, I think that's actually quite commendable. They didn't make losses despite all these things. And also, people are buying despite carbonated soda drink sales decreasing. Many brands like Coke, Pepsi, Dr. Pepper, right, have reported decreasing sales for the CSD in developed markets because of these health megatrends. But yet, SodaStream in these past few years have actually increased 20% year on year. This is commendable. Okay, so the bearish thesis is simple. The bearish thesis is that DIY sodas are a fad, it's not a revolution, people get bored of them. And the fourth quarter weakness is not short term, and it's probably it shows something about the future. Okay, and also Coke's foray into home sodas will add too much competition. So that's the bearish thesis. The bullish thesis is as follows. Well, they still managed positive earnings in the fourth quarter despite retail weakness, right? They still have a continuation of their aggressive growth plans, and these stumbles are acceptable. Their installed base is still growing at a 20% plus clip, signaling increased future profit. There is a continuing mega trend of health and alternative drinks which lends itself well to the DIY sodas. SodaStream maintains their position as the king of CO2 exchange. Coke's foray into home sodas validates the growing market. Additionally, there's space for both the Keurig Coal, which is the machine that Coke and GMC are going to do, and SodaStream. But the thing is this, now that Coke has actually forayed into the home soda market, right, other F&B players, like Pepsi, for example, will be under the gun to do the same. If not, they'll be left out. And all these big brand beverage companies have a habit of basically following each other for fear of getting left out. So that being said, SodaStream is actually the premier partner choice due to the undoubted market leadership, established business model, and distribution channels. They're the #1 home carbonating company right now, which is why already so many brands have partnered with them, as I mentioned before. So if you can tolerate the temporary weakness for this year, the company is setting itself up for good future earnings. Okay, so here, operating growth is still there, as we talked about, the increase in revenue unit sales. Now, rapidly growing flavor partners. Since October, in just 5 months, they have secured this many flavor partners: Cooking Light, Del Monte, Ocean Spray, Welsh, Skinny Girl, and this is an alcoholic beverage, by the way, and most recently, Sunny Delight. Now, to understand this, for example, when Welsh signs a contract with SodaStream, Welsh, as you know, is a juice brand. You can find it in Cold Storage or whatever. Okay, you can find it there. They don't sell carbonated products. So what SodaStream does is they're going to sell a carbonated version of Welsh. So Welsh has signed an exclusive deal with SodaStream. Welsh is not allowed to sell a carbonated version of their drinks outside of SodaStream. So that means if you want a carbonated versions of all these beloved flavors or brands, which are like Ocean Spray Juice, Welsh Juice, you have to go through SodaStream. Hence, you can see SodaStream is developing its own market in a sense. Okay, growing types of distribution. Companies like KitchenAid are actually producing their own premium soda makers, but these soda makers are actually powered by SodaStream. Similarly, Samsung is producing their own sparkling refrigerators, also powered by SodaStream. At the same time, we talked about how SodaStream is in the nascent phases of launching the SodaStream Professional, which is now going to test restaurants in Europe. So these are all different distribution avenues for them. So they're growing in terms of flavors, they're growing in terms of distribution, okay? And of course, the fact that people are still buying SodaStream despite decreasing CSD sales, and that's very commendable. Okay. So here are the plans SodaStream intends to do to improve their margins back to historic levels. For the price, they're establishing higher margin thresholds for promotional activity. In other words, they're going to not do what they did for Q4, basically, so that's fixable. Supported with central invoicing. So now that they've been expanding globally, they will now do central invoicing. For cost, they're going to improve that by implementing SKU, stock keeping unit, rationalization, design to cost initiatives, a new global procurement department, as well as the West Coast filling station and distribution center. Okay. What about growth? So this is to improve margins, right? So you know that the installed base has been increasing every single year, including this year. So as long as margins can improve this year, right, profitability should increase. What about growth? Okay, to talk about growth, let's look at the industry analysis itself. First of all, in the US and most developed markets, the CSD market has actually is a big market, okay, worth $260 billion dollars, but it's been decreasing over the years. So for example, until 2013, CSD sales dropped by 3%, after falling 1% in 2012. Why? Because globally, customers are turning to other forms of drinks, healthier drinks actually, more like water, fruit juices, and healthier alternatives. Okay, if you look at the results for the big beverage companies, it corroborates this data. Pepsi, CSD, Coke, CSD sales all have been under pressure, okay, for the last quarter, including Dr. Pepper as well. Okay, a study shows that CSD makers will take at least 5 to 10 years to transition into the drinks that people seem to want nowadays. Now, SodaStream has been capitalizing on this trend for quite a while right now, okay, and is being the exclusive carbonation partners for beloved juice brands, Ocean Spray, V8, and Welsh. So remember, people are tending towards juice drinks like these. So SodaStream is now offering you a carbonated versions of these drinks. More recently, Mexico recently had a sugar tax, and this corroborates and may catalyze this process that we see here. So basically what happened, so Mexico's sugar tax, right, has an 8% tax on most junk food and a peso per liter, which is roughly 10% a tax on sugar-sweetened drinks. Okay, so this will even reduce more soft drink consumption by 5%, as estimated by Barry Poppins. It's important because SodaStream does its operations in Mexico, but more importantly, with this tax on Mexico, how will US react? Would this catalyze the America's shift in drinking habits? So if they continue this trend of healthier drinks, that bodes well for SodaStream. Okay, so this is a study basically of 93 top executives at leading food and beverage businesses, and they basically identified the top issues going forward in the industry. And essentially, you can see that for the top 3 concerns, right, or rather where the consumer is going, top 3 concerns is health and nutrition, convenience, and price. And these are the 3 things that SodaStream is actually lending itself to right now. Here's a comparison of SodaStream itself. As you can see, it's a simple comparison, just of one of their flavors. You know, SodaStream Cola is 35 calories, and Coke and Pepsi is like 100. Okay, 7-Up and Sprite is 100, and SodaStream Lemon Lime is 35. Okay, and this is just their own flavors. Of course, don't forget there are other juice blends which are inherently more healthy, right? Over here. Okay, what about price? What about soda prices around the world? The question people ask is how much money can you save with SodaStream? Well, cost savings is there, but it really depends on which country you're in, because different countries, soda prices are different. Okay, so for example, this is the price per liter of Coca-Cola. Okay, here Germany is the most, India is the least. Okay, so in the US, right, here's a comparison of SodaStream. In comparison, to drink 1 liter of carbonated water using SodaStream is 25 cents. A generic store brand is actually 79 cents. So you actually save a big hefty sum if you drink carbonated water from SodaStream. So this is the option of choice, especially for carbonated water. For soda, because of the flavor premium, right, the savings is less, but it's still there. SodaStream, if you 1 liter soda costs roughly 67 cents, and store brands 89 cents, you still save 20 cents. Okay, but this is in the US. Here's a comparison for different places in the world. Now, of course, I've done my comparisons in Singapore. Okay, and in Singapore, there's definitely savings. Okay, I think you can do the calculation yourself. In Singapore, by the way, you can actually buy this product. It's already there. But I know that many people are probably unaware of the company, of this product, and that actually bodes well for SodaStream. It just shows there's so much low-hanging fruit because there's so much unawareness. In Singapore, you can buy it from places like Best Denki, the kitchen store at Bukit Timah, the TOTT store, SK Tang. It's actually in these places. Okay. Okay. So the potential for growth, is it over? No, I think it's actually hardly over. We mentioned earlier that the carbonated soft drink market is very big, but SodaStream only owns 0.2% and 2% respectively of the soda and sparkling water market, right? And this is understating the consumer desire to add bubbles to many of their favorite juice drinks like Country Time or Spray and Welsh. Awareness rates show potential for growth. Okay, and household penetration rates are really low. So let's just show you the chart. As you can see, awareness rates, right? They vary, but essentially many people are still unaware of SodaStream, especially in Asia. Okay, and US, which is right now one of the biggest markets, is only at 38%. Okay, household penetration is more interesting. SodaStream has an average of only 2% household penetrations in countries where they are present, and they target a goal to be at minimum 20%. So to give you an idea of what is a matured market, right? Here's Sweden. Sweden, they've been operating there for quite a number of years, and the household penetration there is 25%. So 25% of households actually own a SodaStream machine. Okay, that's what a matured market looks like. US is actually less than 2%, and Asia we're even less than that. So there's actually a lot of growth just by awareness alone and household penetration. These slides are for you to see the updates of the different countries they're operating in and what their growth plans are in the future for them. Okay, I won't go through these because of time. Okay, what about barriers to entry? See, SodaStream has the advantage here. It has the first mover advantage by being basically the only, by far, the global customizable DIY soda makers in the world. Okay, their CO2 exchange is in 60,000 locations and growing. This is actually a big barrier to entry. You see, the thing is, you can't really sell a SodaStream machine unless you have the logistics and distribution system to have CO2 exchange. Because after a consumer finishes his finishing his CO2 cylinder, right, he actually has to replace it with a new one. Okay, so this is actually very important here. Okay, there's expertise in hazmat and reverse logistics. You see, a carbon dioxide cylinder itself, for example, is considered hazardous in the US. So there are regulations on these cylinders, and so you still need to have regulatory acceptance before you can actually have this in the country itself. Manufacturing capacity and decades of know-how. Okay, and patented leading-edge technology. There's some patents on their machines: snap unlock, dishwasher safe, and soda caps. Okay, so far and away, SodaStream is the premier global DIY home soda CO2 exchange methodology. Okay, competition is actually fragmented. It's usually isolated to different regions, and most competition is not on the whole SodaStream value chain, but only parts of it. The only major competitor seems to be the Keurig Coal, which is what Coke is doing with Green Mountain Coffee. But the thing is this actually only comes out in 2015. They are developing this machine from scratch. And it's actually not exactly the same technology, making SodaStream king of CO2 cylinder exchange delivery. The Keurig Coal is going to use pods for single beverage use, most likely. So it's actually not the same type of drink, I guess you can say, that SodaStream is making. The CO2 cylinders allow cheaper ways to leverage on health and taste customization. Of the two, in terms of cost effectiveness to regular soda and seltzer drinkers, SodaStream is likely the more cost efficient solution. Okay, so let's talk about valuations. Okay, So we outlined a few scenarios, right, at this point in time. So this is the bearish one. Okay, so we assume that the net growth of 3% for this year, okay, is a real impairment of future prospects. We think that there's something to it, right? Okay, so we drop our CAGR from a 40% net earnings CAGR to 8%, which is very reasonable looking at the growth prospects of the company right now. So if we do this, right, then we peg SodaStream at 18 times PE, which is major drink brand average, basically. Because major drink brands are going for about 18 times PE, and they're also going by flat or single-digit growth. Okay, so it's a fair comparison. Based on the depressed EPS of 2.02, the target price $36. Okay, so that's what we think is a bearish scenario. Now, a bullish scenario means that we revert back to 20+% NPAT growth. Okay, so if the company reverts back to historical growth on the back of execution and the megatrend, net income growth catches up to revenue growth and historical average. Okay, now the historical average PE is actually 28 times, so that we find that a fair market valuation based on the growth story. If so, the target price is 51. Now, we think most likely though that the real case is actually between the two. So most likely, FY14 guidance is muted, we know that, but there are too many growth opportunities to ignore, and a lot of potential to improve margins and catalysts, right? So we think that 15% net income CAGR is reasonable, because that's the actual CAGR, 3-year CAGR from 2012 to 2014. And if you take this CAGR, that actually includes 2 flat years, right? So we peg that to 23 times PE, okay, which is an average of the bullish and bearish case. Target price $46. Now, in addition, this is the M&A upside bonus, okay? So Pepsi could be a good fit, and they've already suggested that they're going to foray into the at-home drinks, okay? And SodaStream is the best proxy by far to get you into the home soda business because they have the biggest distribution. So how do you evaluate this buyout valuation? Well, when Coke purchased 10% of Green Mountain for $1.25 billion, right? Green Mountain Coffee price spiked 50%. In other words, the market attributed this move by Coke to Green Mountain as an increase of 50% of its equity. Okay, so that's one measure. Okay, another measure could be this. Okay, Pepsi has when they bought Gatorade back in the year of 2000. Okay, they actually purchased Quaker Oats for 37 times PE. Okay, so I think 37 times PE is actually, I think, reasonable for a buyout valuation. Okay, and hence that if there's a buyout, then the potential price target is $74. Okay, so taken together, here's the conclusion. Okay, the growth story we believe is intact because it's actually riding on a mega trend of health, customizable, environmentally friendly consumption amidst gestation losses of expansion while navigating through weak retail sales. Okay, soda will still be king of carbonation. Okay, and there is space for both and for space in the growing market for Coke GMCR product, which only rolls out in 2015. So soda has all this time to increase its distribution and increase its installed base. Okay, in fact, the Coke move into GMCR potentially verifies home soda is not a fad, and they have to take part of it. SodaStream used to trade at an average PE of 28 times, and versus its present PE of 20 times. So any return to historical growth story implies more than a 40% upside. Okay. Now here are the potential catalysts. Now, if they can successfully execute their logistical optimization initiatives, there's going to be a continuation of the health, low sugar drink customization megatrend and a better than expected first half 14. If this happens, these are potential catalysts. As a bonus, soda is also a potential M&A target. Okay. We talked about the valuations just now. So we think that at 20 times PE for a revolutionary company trying to redefine the drink industry that used to have historical growth of 50%, okay, we think downside is limited, but we have to wait for return to growth or realization of the catalysts. Okay, so we value SodaStream at a valuation of $46 from a 1-year time frame. Okay, it's not much. That's about 12% from where it is now, but the thing is, it does carry possibilities to re-rate to between $50 to $74 should the company show signs of returning growth or M&A action. Okay, but this might take a few quarters to see. Okay, so I just want to outline this is the type of investment you're getting into if you buy this. It's a bit speculative and you have to be patient. Here are your key upside and downside risks. Okay, so upside risk, we talked about that. Okay, but the downside risk could be these. Okay, I mean, any changing of government regulations regarding the manufacturing and transportation of CO2 will probably increase cost of delay entry. Of course, it could be increase in cost of supply raw materials. There could be disruption of supply chain, etc., etc. Okay, and that's it for SodaStream. Okay, we shall entertain any of your questions. But there is one question here on SodaStream which I just want to talk about. Okay, the question is, how can SodaStream be a healthy drink? Human body needs more oxygen than CO2. Okay, the thing is this. Um, how do I explain this? Yeah, yes. When you drink, you're not breathing in the CO2. You're just using CO2 as a flavor. When you buy SodaStream, what you're doing is you're buying carbonation. For healthier people who do not want to drink water, one of the only other drinks you can drink, which is flavorful, right, is carbonation. And yeah, it's carbonation. So what SodaStream does is giving you a more flavorful option, healthier flavorful option, which you can modify with juices or syrups and other things like that. I can't show the advertisement on SodaStream right now, but if you go to YouTube and just type SodaStream, you can see a whole range of advertisements. Yeah, you should definitely see the one with Scarlett Johansson in it because she's the brand ambassador. Yeah, feel free to type your questions now. We are waiting your questions. Today doesn't seem to have many questions. We'll wait for 1 more minute, and if there's no questions, then we'll close the webcast. Okay. Here's a question.
Hi, question on Pan United's competitors. Basically, there's one port which is larger than CXP, and it's called Taichung Port. Okay, so these two ports are on the southern bank of the same area, which is the Changshu Xinhua area. And basically, you can say that they are both competitors. However, it's pretty known that Taichung operates at a much higher operating cost than Pan United CXP. Okay, this is because CXP was, I think, it was set up early 90s when land was very, very cheap, and basically that's why they have such fat operating margins. So actually, in any price competition, CXP has been able to lower prices much more than anybody else. And then after the competitors start to bleed, everybody starts to raise their rates again. This is why rates have actually been rather resilient in the area. But anyway, the area has consolidated to just those two, CXP plus CCIP versus Taichung Port. Okay, now CXP also has certain advantages because it's actually the deepest natural port there. That means ocean-going vessels go straight to CXP, and it's therefore their preferred location to drop off cargo rather than more further out, and then you need to use smaller vessels to take the cargo off. Okay, so it's natural-wise also explains why it's also got a lower operating cost because it doesn't need to dredge. Okay, wait, now there's a question on China's export to export slowdown. Now, Pan United is actually more of an import port than export. Okay, so imports in China has been increasing. So actually, although exports have been decreasing, China's imports have been increasing, and actually that's a good sign globally. So we actually should be happy for that, because that means we have another consumption engine, right? That will buy goods from the rest of the world. All right, we actually don't want to see China. I mean, of course, exports are always good for that country, but we actually don't want to see it such that exports increase and then imports decrease. Okay. Now, another question on Pan United. 90% free cash means this 90% free cash versus profit. So if you look at many companies, actually, it is a ratio that measures how well is profit converted into cash, right? And that's one of the measures. Okay, so even despite all its expansion needs, Pan United basically has managed to convert most of its profit into cash, which actually can't be said for many, many companies. Okay, more questions on SodaStream. Hold on.
Okay, questions on SodaStream. Okay, yeah, because I actually rushed through it because of time, so now I can spend more time talking about it. Okay, okay, question by Lydia. Thanks, Kenneth, well covered. I may have missed it. Who are SodaStream's close competitors? Yeah, here's the interesting thing about SodaStream, right? Globally, right, they are by far the #1 competitor. In terms of SodaStream makers globally, SodaStream's probably the only one by far. Most of SodaStream's competition are only confined to specific territories that they operate in locally, that is. Okay, a case in point, and most of their competition is fragmented, and when they do compete, they compete only in certain parts of their value chain. For example, some make soda makers only, some deal with CO2, but none of them actually have a whole complete system, okay, like SodaStream. That's why the only major competition that people are recognizing right now is the Coke and Green Mountain partnership, because these are the only guys, which is big brand company, right, that has the resources to be able to release on such a scale. Yeah. So basically, so right now, SodaStream is the king of the carbonation of soda makers, right? And the only major competition will be next year, 2015. Okay. Now, if you download my written report, I'll actually have a section that discusses that issue. I didn't put in the presentation because it would take too long. Yeah. So some things about the Green Mountain coffee competition that comes in 2015. One is 1 year later. Okay, so SodaStream still has another year to expand itself. Two, the thing is, right, it's actually done. They're using a different technology. They're not going to be using CO2 canister exchange. Okay, in fact, they're going to use basically a pod-like system that produces single beverages. So it's still actually slightly different, which also means that if you use the Coke machine, you're basically trying to get the Coke flavored products single serve as it is. But with SodaStream, right, you have reduced costs and a customization option. So it's even then the clients that they're targeting is slightly different.
Hi, we have a question on Pan United, majority shareholder. So that's the founding family, which is the Ng family. They own 66%. Okay, there's another question on why don't we do more Hong Kong companies? Well, actually, the biggest traded segments, biggest traded stocks at Phillip, Singapore and US. So US is the second largest, and it's quite overwhelmingly bigger than the amount of Hong Kong stocks traded. That's why we do US. But if you do want Hong Kong stocks, write into us. If any of you do want Hong Kong stocks, write into us, and then we'll try and get our Hong Kong colleagues to do a webinar regularly for you guys. Thanks.
Okay, question. It's a technical question. Good. That's a good question since I'm the technical analyst. there's a big price gap down in July. In July for SodaStream. Okay, right here. Agreed. Why? Well, first of all, this gap occurred when the company had first announced their profit warning. So in the end of December, the company announced a profit warning saying that the fourth quarter earnings are going to be weak. Okay, and so so that's why the price dropped here like this. So then after the drop here, market realizes that the weakness was not that weak, and so there was a rebound, and that's where we are right now. Okay, so so I want to say that technically speaking, I will say that SodaStream is still in a downtrend, so I don't have illusions about that. Okay, but the reason why we talked about SodaStream today is because it's at a particular valuation that is worth talking about it as whether it's going to bottom or not. So the question is it going to bottom or not? Okay, and so we outlined the fact that we think SodaStream should probably trade in a range, right? Downside is about $36 here. Upside is probably 46 as well. We think it should be range trading until those catalysts that we talked about come into play. So we think this is an interesting speculative bet but you have to be patient now if you do so. Question again. Does this mean we can make our own Coke and Pepsi at home? Okay, when Coke and Green Mountain come out with their machines, you can make exactly Coke at home. Okay, but SodaStream, they have their own sodas that you can make. They have their own cola flavors and their own other types of flavors lah. So at this point, you can't get Coke or Pepsi from SodaStream. Okay, but so you get their flavors. But you also can get the other brands that have partnered with them already, meaning like Welsh, Crystal Light, V8, Kraft, etc., etc. Oh, I just want to put it out there, right? About the Pepsi thing, that Ocean Spray is already a flavor partner of SodaStream, and actually Ocean Spray is actually owned by Pepsi. That's just something to think about. Okay, here's a good question, right? It's a SodaStream question. If SodaStream's advantage is technology, and since Green Mountain will only be a competitor in 2015, would it not leap from SodaStream in technology or neutralize it? Okay, not really. Okay, I listed a page of discussion on my written report, so please take a look at that. Okay, the SodaStream the technology will be different. That's the thing. It's actually difficult. Okay, for SodaStream, right? Its competitive advantage isn't just the machine itself. That's what a lot of people don't understand. One of the advantages of SodaStream, right, is not the machine, but it's more of their distribution logistics network. Okay, for example, right, every place they expand to, they need to be able to have distribution for their CO2 exchange program, because CO2 canisters are considered hazardous. Okay, so in the US, right, for example, you cannot fly CO2 canisters around, neither can you send it by mail. So everything has to be done basically on the road, okay? And so you actually need a distribution system, and you have to build it. Okay, so there's infrastructure to be built before you can actually sell, continually sell your soda machines. So that's what SodaStream has successfully done. They've built this system in many countries around, you see, which is why if you partner with SodaStream right now, you can get your product out to the market right now. So if you want to do things the way SodaStream does things, you would have to basically build such infrastructure from scratch. So what Coke and Green Mountain is doing is using a different type of technology, and hence you will get a different type of product focusing on a different type of client. So I wouldn't say that it actually is better in technology per se. It's more of what you actually want as a product. By the way, in 2011, there was a competitor that tried to copy what SodaStream is doing, and it was called the Flavor Station. Okay, if you Google flavor station, right, you see that there were two competitors that tried lah, and one of them is called Flavor Station, and the Flavor Station basically has stopped aggressive competition already. They've really gone by the wayside. And the other company that tried doing what SodaStream had done, right, their CO2 canister actually exploded, and so they basically been recalled from the market. I mean, I'm just showing that what SodaStream does is not that easily reproducible. Okay, I think that's all the questions we have for today. So we're going to close the webinar. Thank you very much, and we'll see you next week.